You're listening to Energy Insiders, a weekly update on clean energy and climate policy with Renew Economy's editor Giles Parkinson and leading energy analyst David Leach. Energy Insiders is brought to you by Evergen, providing cutting-edge energy management software for battery optimisation, virtual power plants and distributed energy resources. And Pylon, helping solar installers and retailers design high-resolution solar proposals in minutes.
Hello and welcome to this latest episode of the Energy Insiders podcast. My name is Giles Parkinson. I'm the editor-in-chief of Renew Economy and editor also of the EV-focused sister site, The Driven. And joining me, as usual, is ITK principal David Leach. David, you're back from a big foray into town, back into the CBD and back again safely and sound.
Yes, I took my cut lunch and my GPS unit, but I suspect you'll need a bit more than that heading off. But I'm sure our audience doesn't want to hear about our daily excursions. They've got their school kids to talk to them about. Let's get on to what's been happening this week. What has been happening this week, Giles, besides a couple of great interviews that some podcasters have been doing? We've got a great guest this week, haven't we?
We do. Look, it's all about big batteries. We've had Origin and AGL come out with their results this week. They'll be followed in a fortnight's time by Energy Australia, and they're all talking big batteries. And our interview this week with Sam Reynolds from Octopus Australia just happens to be about big batteries.
Well, to be fair, he's also got some solar and even a wind farm, and says the wind farm, the Delacker in Queensland, is performing well. But why don't we hear it from the mouth of the man himself?
Okay. We'll come back with the news after this, but here is Sam Reynolds from Octopus Australia. Sam Reynolds, thank you very much for joining the Energy Insiders podcast.
Thank you for having me.
Look, we're having you on because you've just announced a whole string of new purchases of battery projects, including what at the moment is ranked the biggest in the country. But every time I type out a biggest in the country headline, somebody else comes along and about 5 minutes later comes up with another big project. And you're building a couple of projects already, solar and battery hybrids, and I'm really keen to explore that. But why don't you just first tell us exactly who Octopus Australia is? Because you're big, you clearly got a lot of money, but most people don't really know who you are.
Yeah, no, great. So we're a fund manager. We also invest into development, construction, and operation of renewable energy assets in Australia. We have our heart or our founding back in the UK. We're 60% owned by the Octopus Group. Some of your listeners would probably know of maybe our sister company, Octopus Energy, that is in the press a lot globally. So we run a fund. That fund is an institutional fund called Oasis that has investment from the Clean Energy Finance Corp, Host Plus, Rest, superannuation funds, a couple of other supers in Australia, as well as the APG pension fund. APG is the biggest pension fund in Europe. And that fund invests into the full life cycle of renewable energy assets.
I think those funds under management add up to about 1,600 million.
The funds, yeah, that's about right. Yeah, we've roughly got commitments for about 2 billion at the moment. And yeah, a bit of a play on what's actually deployed. But yeah, commitments of about 2 billion today.
Yeah, that's amazing. And so the purchase that you announced last week, you bought the Hanworth. We bought two assets actually. One's the Hanworth battery, and the other one's the Dunmore solar farm and battery, a solar battery hybrid. And I'm very keen to, as I said at the start. But tell us about the Hanworth battery. It's a bloody big battery, 1.2 gigawatts, 4.8 gigawatt hours. That's 4 hours of storage, almighty, next to the Bannaby station. It's not the only one trying to sort of connect into the Bannaby station. What's the...
Bannaby, for our listeners, is inland from Port Kembla in New South Wales, more or less, and on the connection of Hume Link and the other transmission lines in New South Wales.
So it's sitting in a very good place. But so what's the plan here?
Yeah, look, great place to sit. I think there's about 3 gigawatts of capacity on that connection, which is amazing. Look, and bit of a plan of a wider strategy for us to have a ring of batteries around Sydney. We're building in Bungendore, just not far from Sydney, a large solar and battery project at the moment. We've got another one coming through.
That's Blind Creek. Sorry to interrupt.
That's Blind Creek. Yep. We'll have another one in that area shortly, and then Hanworth, and then there may be one more coming through. What that allows us to do, different grid connection links into Sydney. So a bit about our model in Australia is that we do what we want to do is reliable energy. So using our generation assets, our wind and solar, collectively with our batteries. We own 100% of all those assets. And we want to sell that as one load of generation to the market so that we can compete with products that you might see from coal and gas. Uh, but our product's a little bit more refined because we can add a bit more precision to what we're offering the customer and matching up to what the customer actually needs.
So tell us a bit more about this idea about a ring around Sydney. It sounds like sort of laying siege to the place and calling for a surrender or something. But maybe you are of the coal assets. But yeah, what's is that just because you're just thinking about different transmission lines coming into Sydney, and that's where the advantage is? Because I'm guessing with a battery the size of Hanworth, you're not just thinking about arbitrage and storage. You're thinking possibly virtual transmission. I mean, what else?
I just note, Giles, too, that there's the Sydney transmission ring is part of the development of Sydney transmission that has to be built, and the part particularly, I think the part north of Sydney is already sort of done and dusted. The part south of Sydney, particularly from Humelink up to the city, is still a bit missing, and the cause of a lot of transmission from the south has been the cause of recent price spikes. Yeah.
Yeah, so definitely not laying siege to the city. I'm a Queenslander and I do live in Melbourne, so it'd be nice one day. But definitely about different grid connections and reliability for our portfolio. So if we are going to the market with what we want to say is a firmed product, a reliable product, there's a risk there for us that we must make sure that we can deliver on that product, which means we need a number of different the transmission links into the big demand centers. And that's what this big battery will be part of.
Right. And so what do you need for it to happen to get this built then? I mean, I think you told our reporter from Renew Economy, Sophie Vorath, when you talked to her earlier this week, that looking at financial close by 2028. So are you looking at a particular part of the market? Are you looking for a CIS contract or a New South Wales contract? Is it going to be a mixture of services?
Yeah, great. Yeah, so look, it'll be a mixture of services. So we'll contract part of it. We quite like our assets to have a mix of long-term contracts or sometimes tolling in regard to batteries, but also an element of merchant coming into construction and operation. We see the merchant element more interesting for shorter-term products, 2 year, 3 year. If you look at the C&I market in Australia, most of the corporates are used to 3 year contracts. They're not used to signing up for 10, 15 years. That's just a step too far for their team, especially if they don't have an energy professional in-house. So we want to do that. We can get some better pricing on those 2 and 3 year contracts. We can cycle them through. Then you get a chance to work with the corporates to say, look, if you did buy a product which is a bit longer, we could probably price it a little bit better for you. You can hedge your energy better, a little bit better, and start to warm them up into what energy can do for them and their bottom line. And that's the key that I think that's different from us. We don't want to see ourselves as just selling energy. We want to see ourselves selling a product that the customer actually wants, that matches with their demand. Solar, middle of the day, wind coming off and on. For us, we're relatively coal, actually, to be honest, is a relatively low value commodities. They're inflexible. They're not necessarily looking after what a customer really needs in the 24-hour period. It doesn't necessarily need 24 hours of energy all the time. So we want to make sure our products are precision-based, which makes them efficient for the customer to buy, and then allows our investors to get great returns.
Just tell us a bit about then, just the cost of such a project. I mean, what are you seeing with battery prices? We've reported a lot about how much battery module prices have come down over the llast couple of years. 40% in the last year, 60% in the last 2 years, 80% over a longer period. Presumably, this has changed the game for battery storage, plus the development of the markets, the market opportunities. What are you seeing from suppliers? Because you've got a couple of battery projects under construction at the moment. You've got, Blind Creek, which you mentioned before. You've got Fulham Solar Farm and battery as well. So you've bought some batteries, you're installing some batteries, and you're lining up a whole bunch more.
Yeah, and I think it's that scale. So Fulham and Blind Creek are the same EPC, same battery supply. You can start to sort of get some some great pricing on the economies of scale, and definitely one of this size with Hamworth. And yeah, same thing. We're seeing 70-80% drops in battery pricing. It's not just the battery pricing that improves the economics. It's the proven bit of of tradable and how you can use the battery and the technology at the other end, how we can maximize the batteries as well. Also within our team, we've got a big energy markets team who do it should be called the Energy Magic team. They do amazing things with data. I'm still very much an Excel person and two-finger typing, but these guys are magicians when it comes to helping us forecast how that battery is going to perform on that particular part of the grid for the next 5, 10, 15 years.
They're magicians when it works, but they'll be in the doghouse when it doesn't, won't they?
Absolutely.
Yeah, sorry.
Yeah, that's exactly right. Yeah, if I don't need to understand it, it just needs to work. And that's key. So when we price these things, we can start to look at a very long horizon. And if you've got that energy team, the data team in-house, you can see what volatility is going to look like. It's very different to just running a 30-year curve through your model and sort of trying to sort of work out how a battery will perform. If you do it in your 5-minute packets and really see the volatility, then you can really price how these things will start to operate within your fund.
So if I look at the portfolio, there's really only the one wind farm at the moment, which is Dulacca, and that's relatively new and in Queensland, I think, and you know, sort of small by the standards of the way we think about wind today. How's it been going for you?
Dulacca's been an amazing asset. So it's got its wind profile, like similar wind farms in southern Queensland. It starts blowing at about 3 or 4 in the afternoon, blows through the evening, comes off relative in the morning. It's amazing for Queensland. It gets a lot of the pricing, and any hiccups with Callide B, it picks up a lot of that sort of stuff, which is great. So yeah, no, it has been a great asset due to the evening profile, and that's it's a relatively simple one to explain to our investors of how actually our model should work in the real world. Is that we want our wind farms generating at night, solar obviously during the day, and a number of batteries on different parts of the grid to give that firming and reliability, and that's how we can de-risk a portfolio.
Let's take that for granted. If people listening to this podcast don't understand that by now, I'm giving up. But I just really wanted to come back to the thing that interests me and my background, and that's the fund. To be honest, you've got a couple of super funds in there from Australia with, 150 to $200 million contributions, which is certainly important. The superannuation sector has been in the news a little bit just recently by pointing out that, in fact, a lot of Australians are getting ready to retire, and super funds have to be very liquid to allow for that, and it makes it difficult to invest in longer term assets, even though we all want them to do a lot more to invest in this sector. I just wondered what your thoughts might be around that, as having got some of those guys in.
Yeah, look, we've built in different liquidity measures for that. Also, part of some of the early release super schemes that were running through COVID, the funds were concerned about that as well for long-term infrastructure. Our fund, Oasis, is an open-ended fund as well. It's not a closed-end fund, which you may see in renewables, which 10 years. We don't think those funds work for renewables. The development time, the construction time just takes too long to try and get a portfolio together in 10 years and then sell it on, then be sometimes forced to sell it on at 10 years or 12 years. So we've built some of that flexibility into our funding arrangements. So that the other good thing with us, we've got some very big investors in there. Host Plus Rest, over 100 billion. APG is $1 trillion fund. If any of them, they can trade their stakes amongst each other at any time. And so if one is a little short or has just bought something else around the world, it can trade that, has to offer that to others at any time. So we try and make it work for them 100%.
Of course. And just on that, I mean, what's the prospects, do you think, of getting more Australian super money into your fund and more broadly into funds that invest in these longer duration, relatively lower returns? I've been concerned about the MySuper returns type of thing that kind of makes it very difficult for a super fund to invest in transmission, for instance. The regulator says one number, it might be a lower number than what MySuper has as its default number, and bingo, you suddenly lock super out.
Yeah, absolutely. Look, it's one of the things we targeted straight from the get go is that we need to be delivering double digit returns for these for the superannuation space. They're just not interested in single asset, late stage single digit returns. And that actually shaped our strategy a lot. We need to be maximizing how we're getting those high returns who are better through that revenue product. So that product is sold at a premium because it's firm, and that gives us a better returns to our investors. Uh, Look, in the nicest possible way, institutional investors, that's the only thing they really probably care about is the returns.
I don't think that's quite true, but I think it's a lot true. It reminds me of a joke, but I'm not allowed to tell jokes just this week. I just want to go on because I've got a long background in sort of looking at managed funds. Macquarie Vehicles, Macquarie Airports, Macquarie Roads, Transurban, and stuff. I think about had to think about far too much, and I always think about the fees. So the thing is, these assets offer, like if you look at the weighted average cost of capital for a wind farm, say, you'd be lucky if really out of the textbook it was 10%, if you know what I mean. And then you think about that 10% and you think you've got a base fee in your fund that might be, I don't know, 1%. So, you've kind of knocked off 1% out of your 10% straight away. But also then there's the performance fees. I mean, you're probably not going to get performance fees with straight wind and solar assets, are you? I mean, they're going to do the same thing every year unless we can encourage Russia to invade China or something interesting, or the United States. So pick on Trump. So Trump wouldn't be picking on little guys. He'd have to pick on a big guy. Sorry, I'm getting off topic. But I mean, how should we think about what sort of returns are actually needed? I mean, the prices for consumers have to go up quite a bit for every percentage increase in fees. And I especially think about that in relation to all the wind that has to be financed. Very long question, I know.
Yeah, no, good question. I think we could talk about fees for a long time. I definitely spend far too much on RG97. I'll let your listeners Google that for fun later. So look, the supers are incredibly sensitive to fees, and I think far too sensitive in my view. Sitting on the other side, I think they were quite. I think they. If you look at net returns, so all of our returns, what I'm talking about are net returns, are after fees. Our fees are very reasonable because the supers need them to be, because there's a heat map and they're advertised and transparent. They look at fees more than just net returns, and I think that's the wrong way to look at it. I think international funds are a little bit more. We'll look at net returns first and fees second. I think we're a little bit around the wrong way in Australia. And the thing I generally say to the supers when they come to us with a ridiculously low fee, or sometimes some of them will ask for zero fees, I just say, how did you expect me to give you 10-12%
Yeah,
higher?
like they charge zero themselves. I mean, this is the point. The fees compound. Like if you're a member, and this is semi-serious, but it's an interesting question. I mean, the super fund has to earn a fee for itself that comes out of the members' contributions, and then it pays you a fee. These are relatively low return infrastructure assets to start with.
Not in our model. Not in our model. So our model is a higher returning model because it gives a product. We're not selling a low value commodity. 100% with your example on single solar, single wind. Absolutely, you're struggling. The supers will struggle to invest into that.
I'll hand back to Giles in a second, but another thing that I like about what you're doing, and we had interviews with Andrew Smith from NAB about having a portfolio approach that tends to lower your costs of borrowing, and lower your cost of equity because it's spread around a big portfolio. And after that, I just want to ask one more question.
Yeah, no, exactly. Everything we do needs to tweak, get the costs and the efficiency down. The scale helps. Having an EPC work on multiple assets, having battery suppliers work on multiple assets to give them the scale. Pooled project finance in that portfolio structure. Again, having a precision product that hits the market, not just solar when it's generating or wind when it's generating. It doesn't actually do generation without flexibility is not of any interest to the market. And supermarkets want to have the freezers running at night. You can't do that with solar only. Data centers are going to be the next big thing that needs a product. They're probably still buying energy a little bit like they've done for the last 10 years. They need to start buying energy that works for this new industry. And we're developing a product specifically for that, so that we can educate them on what you can do with renewable energy, because you can get it for reliable, you can have it for precision. And all those things come into lowering making the sites more efficient, but also lowering the risk for our investors. If we have a portfolio dotted across the eastern seaboard, different weather patterns, different grid, again, you want to try and get that cost of capital down as much as you can. That's a big part of the cost of energy in this country. And
I agree with that very strongly. And so I just want to ask the one question I try to ask as often as I can, which comes to all these wind projects, these big wind projects that have to get financed in New South Wales. I suppose I want to ask this question in as open-ended a way as I can. You reckon they're going to get financed from what you see?
Let's just say the ones that have a good long-term operators behind them that have funding, like us, if the project should get funding, then if the project is good enough, it should get the funding. The projects that won't get funding are projects where you're siphoning debt to a development project. You haven't quite locked in different things. You don't actually know where's the equity coming from, who's running construction, who's running the 5, 10-year, 20-year operational model. Are they part of a portfolio of stuff, everything we serve out? But the only last thing I really want to keep going on the fees, but I know we've got to move on. What we need to see less of in Australia is big financial investors going directly into renewable energy assets. So we don't do any co-invest. We don't do any of that. Super fund buying a big wind farm or an international pension fund doing the same to avoid fees is not good for the Australian energy market. What happens is, on the other side of the table from that deal, there's a very, very well-skilled EPC and engineering firm or a developer that will win any disagreements in contract or liquidated damages every day of the week. Then that super fund gets lower than expected returns than what it thought it was going to do, because it doesn't understand necessarily the model and the grid and all this stuff that needs to go into running an asset, a high voltage asset. That impression goes out to the market that renewables is risky. That impression then increases the cost of capital. That's when all financial investors start asking for, no, this is not now a 9% asset class, it's 10, 11 or 12. So that is the biggest thing, is why these things shouldn't be done without fees.
I agree with that. And I agree with the portfolio approach. Well, I don't know about without fees, but I certainly think that you want a team of equals, if I can put it that way, sitting around the table. The contractor, the developer, the financier, they all have to know what they're doing, and probably a skilled platform operator is the right way to do it. And I also very much agree with this idea of scale, because wind and solar do benefit enormously from a lot of scale. But anyway, back to you, Giles.
Yeah, look, thanks. Look, I'd like to bring it back to some of the actual technologies, and I'm particularly interested in the solar battery projects, because the one you're actually building two at the moment, so Fulham and Blind Creek, and you've got another two lined up at least, Ardandra and Theodore Solar Farm. They're actually sort of all quite reasonably small. I mean, of course, you've got Dunmore. How are these going to operate? Because, I mean, the remarkable thing about solar batteries is that there seems to be about 24 projects lined up with capacity investment scheme underwriting agreements. I think you've got one or two. Yeah, we haven't actually seen anything in the main grid yet. We've seen one over in Western Australia, and we've seen it store electricity from behind the meter and send it into the grid in the evenings. Tell us about just, I guess that's the main principle. You store it to avoid negative prices. You're putting it into the evening when demand is highest. But what are the actual economics and dynamics? And just tell us a bit more about the theory.
Yeah, look, so we again coming back to the product, really the market only needs a 4-hour firmed product at the moment with the duck curve the way it looks like. You don't need to necessarily hedge 24 hours in Australia. And that's what you can do with precision solar and batteries. You don't necessarily need a coal-fired power station that is selling a product to the market that is going to dip in the middle of the day, needs to be turned up and down, creating risks and shortages and all this sort of thing. So that's what we're competing with. And if we can't compete with a 30-year-old coal-fired power station doing that stuff, we're doing something wrong. But that's what we want to do with our hybrid projects. Look, I would say hybrid projects sound easy, but they're quite a difficult beast to get into, to develop and get into construction.
Why is that?
Of how the battery and the solar projects working within the grid and the different dynamics, and it does take, so within our team, it does take us engineering and grid team to understand when those assets are generating and what they're actually doing engineering wise. Then you do our energy markets wizards, if you like, telling the team this is what the energy price is doing, this is how the product should work to de-risk it. That is a coding team. Then you've got an investment and legal team that needs to put the commercial wrap around this to make it work for everyone. And if you think about all those different groups, the 6 different sort of individuals and backgrounds, your legal and investment talking to very young coders and that sort of thing, talking to engineers wearing steel cap boots. That is not an easy mechanism to work out. That comes back to the Octopus culture. So these things are not for the lighthearted. Developing these projects, they sound relatively easy and straightforward, but they're difficult things to get away, but important for the grid.
Well, you're hopping right in there because you've got like 5 lined up already and 2 under construction. Will the first one off the line be Fulham?
First one, Fulham.
Okay,
Yep.
right.
The first panels, first 100 panels were installed yesterday, I think, on Fulham. So
Oh, there you go. Okay. Well, it'll be interesting to see. And have you got sort of customers for these things, or are you just sort of playing with the market and
customers, so PPAs are locked in. So Fulham is actually a VRAT project. And then White Creek has a one of the first sort of 4-hour firmed PPAs.
Right. Okay. And you've also got a couple of wind and solar.
Sorry, who's that with?
I'll just have to double check if we've announced that. You might actually even know in your own article. But I'll have to just check.
No, I didn't mean to interrupt. Sorry, I was just interested.
Yeah. So I do know it. I just I wasn't too sure if we've announced the party yet, but we are doing a sod turn with the New South Wales Premier in mid-March, where we want to be a bit more to have something to announce at that event. Yeah.
Okay, we'll look forward to that. And also in your development portfolio, you've got 3 reasonably sizable sort of wind farm and batteries. We've got Gifford and Saltbush and Merino, or 2 in New South Wales and 1 in Victoria. So how do they work then? Is this once again sort of sharing the same connection point behind the meter, or is it just co-located?
They're a bit further. So I think they're a little bit more co-located than what we're actually doing with the hybrid. So wind obviously a little bit more challenging in forecasting how it's going to work with a battery. I don't know if it's not quite the same model. It's more you could almost say they're separate assets rather than the hybrids we're doing on the solar side.
I mean, solar and batteries are a natural partnership. The batteries run every day when the solar goes down and you sell it into the evening peak. In fact, I had one financier tell me that he liked these hybrid projects and he'd like them a lot more if they didn't have any solar.
It was interesting that AGL actually were talking about their Torrens Island battery and reckon they were getting like a 24% yield on their from their capex.
Batteries on their own short term, I think are great investments. Batteries on their own without their own generation, I think when a coal-fired power station goes down and everyone wants the same energy and you're trying to feed your PPA from your battery that doesn't create energy, it just moves it, I think becomes quite risky.
And I was going to say the other point is that so the batteries are very predictable. You use them every day with a solar farm. But as we remarked last week, when you've got kind of a mixed solar and wind farm, then what you find is that you're much more risk of the output dropping to very close to zero at unpredictable times. And so you need more batteries, even though you use them less often in those kind of bigger portfolios. And that's why a portfolio of solar and wind, probably with more wind than solar, still remains, I think, the overall most effective way to go. Anyway, I didn't mean to interrupt. Sorry.
That's okay. But just look, it's interesting looking at your portfolio. I mean, you've got two operating assets, which you've inherited, which is the Darlington Point Solar Farm and the Dulacca Wind Farm. But every other project that you're doing now is batteries included, either behind the meter or next to. I mean, I guess that's the story of this stage of the energy transition, isn't it?
Yeah, and look, I guess the way we look at the NEM is like it's a big jigsaw puzzle. And there's three different coloured pieces: wind, solar, and storage. And we need to specifically locate those three technologies in different parts of the grid to fill out what we see as the most reliable portfolio for the market of the future. As you know, with building a portfolio or a pipeline, they don't necessarily all line up and come in at the same time and connect at the same time. But we want the right mix of wind, solar, and storage in each state so that we can do these, protect our portfolio and do these reliable products. And that's how we're building. And so everything is being built with that sort of future 10-year plan. We'll also buy some operational stuff. I think there's some stuff coming through that's probably coming up to refi that's feeling a little bit unloved. That could work within a portfolio. They can make solar work within batteries and that sort of thing, and a few other things. So I think there's some opportunistic purchases, if you like, that we can start to look at as well.
Third owner
And-
makes
and-
the money. Sorry, Charles.
And what's giving you a headache at the moment? Clearly, you're not struggling for finance at the moment, but maybe it's not quite as simple as that. But is it connections process? Is it planning approvals? Is it government policy? Is it social license? What's causing your biggest grief? And
Look, I think we're growing quite quickly. Like it's probably a little bit more internal to start with. We're growing quite quickly. We need more. We've got a lot of roles out there for staff, sort of development and engineering are big ones. That is something we need to manage that growth carefully with our culture as well. We want to have this collaborative culture where lots of different divisions are talking. I know culture, a lot of time I talk to culture and a lot of people roll their eyes, but it is actually quite a key part of the energy strategy in Australia, how that team communicates.
Can I just interrupt there? I apologise for interrupting, but I know your time's short. I was researching this, and I think your Octopus Australia is a certified B Corp. Like ESG, a lot of initials, alphabet letters here, has gone a little bit out of fashion, but how do you fit in? Tell us what B Corp is and how it fits in with shareholders getting a return.
Yeah, so B Corp is all about saying an organisation will have multiple stakeholders, shareholders, employees, the environment, the community. Look, it's more common sense than something specific. And I think that's what ESG is to us. It's more common sense that. Yeah, it doesn't raise us capital, ESG. It never has. We don't talk about ESG within our funding docs because it doesn't talk to returns. Internally, we think ESG is just good corporate governance for any long term. I don't think it should be different. It is not a selling point, if you like. It should just be part of the foundation. Look, and we get a lot of questions. I was there. This sort of what's happening in the US with Trump, has that removed people's interest in ESG? I was like, to be really honest, funds were never investing into ESG. Let's just be blunt. They've got an ESG department, which on $100 billion fund might be worth $100 million. It's a very, very small allocation to specific ESG. So that's not what we're playing in. We're an energy infrastructure player. We want our assets to sit alongside their airports and toll roads and gas pipelines, because we're giving them similar level returns to those. Once you start talking to them about 7-8 returns, but great ESG and stuff, they're not interested.
Oh, interesting stuff. Look, Sam Reynolds, thank you very much for joining us on the this episode of the Energy Insiders podcast, and we look forward to hearing more about your developments. When the first solar batteries rolling off, and to the progress with what is rated, at least for the moment, as the biggest battery project in the country. But yeah, better do something while you still got that title.
How many people have you got now?
We're getting on close to 70 people in Sydney and Melbourne. Yeah, and then.
And where do you think you'll be in a year's time?
I think we'll probably be over 100. Yeah, I think just as we layer in more and more assets in construction and development, as long as the funding's there, yeah, we've got a big appetite.
And you'll probably need a retail marketing department as well eventually. It's one thing to be a generator and have this wonderful product, but you've got to sell it and layer on the sales as well. It's almost as hard as the actual making the product.
Absolutely. Yeah. So yeah, watch this space. Yeah.
Thanks very much, Sam. That was Sam Reynolds from Octopus Australia. We'll be back with the news of the week after this short break.
Hey solar retailers, the GoodWe Rewards platform is back with $20 million in rewards available for you. Claim on every 5 and 8 kilowatt hour ESA battery module or ESA 30 kilowatt 60 kilowatt hour unit purchased from your distributor. Redeem your rewards on anything in our online catalogue, including Visa gift cards. Record, submit, get rewarded. Visit goodwerewards.com.au now.
You are back with the Energy Insiders podcast with Giles Parkinson and David Leach. David, still smiling. Interesting stuff from Sam Reynolds. I like the fact that there's a big new independent player in the market building batteries, because what we do
not big enough.
Not big enough. Well, I mean, you've written a really interesting article just talking about how batteries have responded to we've had peak demand, record demand at various times over the last year. Batteries seem to be playing their role in sort of tempering that, but clearly I think we need more batteries, more batteries owned by independents and not by the big three.
Well, AGL's results, I think, showed that they're getting a 23% EBITDA to total cost return on their battery in South Australia, Torrens Island.
Yes.
And that's a very encouraging number that will certainly people continuing to think about investment. However, the real reason why $1 billion or whatever it is that Octopus has got is not a lot of money is because of all the wind farms that we need to build in New South Wales, where I think we probably need 20 billion to turn up and all these wind farms to get to FID in the very near term. I don't even mean in a year's time. I mean in the next 3 to 6 months. That on this in my watch, that's the number I'll be looking for all the time. Which wind farm has been financed this week? Which has reached FID?
Yeah. Was it true to say that Urunga, the Andrew Forrest one, is about the only one that's being built in New South Wales at the moment?
No, Urunga is just next to Bellingen, and it's a great surfing spot. But I think it's the Yungula.
I was close. I started with a U. It is a good surfing spot on Urunga. But anyway, yes. The Ungala one. Yes, well, they've got helicopters up there stringing wires between transmission lines, which is very exciting. But there's not enough of that going on.
Not nearly enough. And, we're at the stage now, and you could have knocked me over with a feather, but the transmission's going to be built long before the bloody wind farms to connect to it are the way we're going at the moment. And that's even if Humelink is built a bit later than what the official date is, and you won't win a lot of money at the down at the pub for betting on that.
No, well, that's right. Yeah, even Project Energy Connect, which is the new sort of transmission line to South Australia, is not going to be completed now, I think, until the end of 2027. So but that was probably to be expected anyway.
So we have to get on with it. Now, the other thing that showed up in the AGL results, and I haven't been through the Origin ones in detail, and I haven't been through the AGL ones in enough detail, is that in fact, not only were their customer numbers up, which is not that surprising because we've had so much population growth, but the actual residential volumes in total were up a couple of percent. Now, overall consumption growth in Australia is up about 8%, and mostly in the middle of the day, which is interesting. But so we're not really seeing this sort of death spiral in the networks that the networks are facing just yet, because the residential volumes that have been sold, which are going to be coming from the operational volumes from the utility side of things, they're still continuing to increase. I haven't looked at the Origin numbers yet, but I'm sure it's a very similar story. So we're getting this great nervous thing about pricing in the networks and moving towards more fixed costs, which sort of upsets people, and I think it probably upsets them rightly in a way. But what we don't have is a good answer. Some people have these like thought bubbles. I'm not looking at you, Giles, about building the cost of connection into the house price. You know what I mean? So it's a one and done type thing, but that's not going to fly very much either. But we do have to. But there isn't a death spiral at the moment. That's the point. Networks actually want more money, as we said on the podcast. They used to want more money for. Because solar was a problem being exported to the grid, and that was going to overload the system. And now they want more money because the houses are going to electrify and everyone's going to import more power. Yeah, it's funny, isn't it?
Yeah, it is. But look, there's also a bit of controversy over the AMC's new rules, which I think we've discussed before, or these sort of proposals about hitting some of the solar and batteries, like people like you and me who don't draw much from the grid, who've got solar and got batteries, and hit them with an even bigger network fee. But that also hit people who don't use much electricity. So, this sort of goes around. I think these sort of proposals, went around about 5 or 6 or 7 years ago. And even though you say there is no sort of death spiral at the moment, it's in that same theme, is about the networks not being used enough. Let's make sure that everyone is paying their share of the network fees.
The question is, what's the policy? How do you actually want to, there are two problems, right? The problem is that we have to pay forever for the actual networks, and we never get a chance, and most of what you're paying is a return on a fixed amount of capital. You're paying for the fact that all these wires and poles are in the ground. It's not that the substations are overloaded or even that there's a huge amount of new capex needed for them. That's not true. You're paying for infrastructure that in most cases has an average age of, say, 30 years. And we have to pay forever for that. And the question, and since it's a fixed sunk cost, there is no right way to pay for it. I mean, you could charge a fixed cost, you could charge it on volume, you can charge however you like. But the trouble is the networks are entitled to this fixed amount of revenue every year, and it's just a matter of what policy you adopt so that they get their fixed amount of revenue. I like to think about that amount of revenue.
Yeah, well, it's going to be interesting to see what they come up with. Look, elsewhere, I'm not too sure what other sort of news has been around this week. We've had the regulator give a tick to the Marinus link, which I don't think is any surprise, but has caused a lot of angst down in certain parties in Tasmania and in Victoria. But that's going to get built now with the regulatory okay.
I don't think anyone can be very much surprised about that. I think that was a certainty for ages. And I was reading about a Chinese a transmission line from Tibet to the eastern China, I guess. It's getting built. That's going to carry 10 gigawatts of high voltage. So that's the sort of line where you can certainly build a lot of renewable energy at one end, and it's going to be quite cheap. But then we all know the translating costs in China to costs in Australia.
Yes, yeah. I was actually interested to see, one story that we ran today was about the coal-fired generation in China and how flexible. I mean, it's got built-in flexibility, which is something that we've talked here when we've interviewed people like Frank Calabria and Damien Nix from AGL. They've talked about the sort of high flexibility of their coal units,
I wrote a note about it. I showed how much more flexible they've actually become in New South Wales, particularly Mount Piper and Bayswater.
Yeah. And they've just kind of moved on from this whole concept of sort of base load to sort of basically flexibility. And it's remarkable how much the
China's always had that, to be fair, Giles, because China's always had a huge amount of capacity, and the average amount of capacity utilisation for a Chinese coal plant hovers around 50%. So they never really had a whole lot of gas and stuff like that, and they've always used the flexibility in the coal to deal with the peaks they have. It's not as peaky a market as Australia anyway, because it's so much more industrial load than what we have.
Yeah, no, fair enough. And we've had another couple of outages this week. You've also written a note about this, and I've written a note about it. Vales Point just had a $40 million upgrade. Hasn't been appearing much since the completion of that maintenance upgrade. Was supposed to be back online. Went out again on Monday. Was supposed to be back on Tuesday.
I think it's back now.
It is back now, is it? Okay, finally got back on Thursday then.
It's interesting looking at that outage last week. Someone was suggesting to me that because that was an outage south of Sydney,
Yes.
and we've discussed all the transmission upgrades that are needed there. But of course, some smart operators in the market, not looking at Snowy or anything, kind of see this outage coming, and they kind of make sure that they're operating like crazy so that when the outage happens, they get dispatched down to Victoria, right? That sends the price negative in Victoria. But Snowy gets the New South Wales price, even though none of the power actually goes into New South Wales. It's they're not the only ones, but it's just you've got to be smart to be in the business, haven't you, really?
Yeah, well, there was a few funny things happened. I think a few batteries got caught out trying to sort of having to charge at the market cap, but not for very long and not for very many megawatts. But that was interesting anyway.
I think some batteries are actually don't always obey the instructions either. I've heard, it's a bit like professional soccer, is it? They see the ref and think, I can get away with this one, and they end up dispatching when they're supposed to be charging.
Well, if the price is $20,000 a megawatt hour, then I'd be trying to get away with that one as well.
It's interesting. So, I mean, you can have a ref and you can have rules, but you've also got all the players in the market. And I suppose that's what makes it very exciting, Giles. But what else I don't know that there's a lot else to be talking about right now.
No, not a lot happening really. We've seen, look, there's been a lot of new batteries and solar farms and wind farms starting to, well, not many wind farms actually.
Yeah, Golden Plain Stage 2 getting into the market. I mean, you have to give those boys credit. I mean, I know we've contrasted them with McIntyre in Queensland many times. And the funny thing is, when you're talking about Queensland, whether you look at the biggest growth in demand, the biggest impact that batteries are having, the biggest impact that new wind is having, it's all in Queensland. It's a kind of legacy of what was done by the previous government. But down in Victoria, meanwhile, I think West Wind and Toby Geiger and Golden Plains, they've all done well. Stage 1 is up and running. Stage 2 is starting to commission, I think, pretty much right on schedule.
Yeah, absolutely. Yeah, so that's pretty interesting. Look, the only other things that there's still work being done on those massive renewable hubs over in Western Australia. The Australia Renewable Energy Hub is now called nominally 26 gigawatts. We'll probably have just a couple of gigawatts. Got some $21 from ARENA to further its investigations. That's the one that BP bought a majority shareholding in and then kind of dumped it when it decided it wasn't interested in renewables anymore. And even bigger down south, across Australia in the Nullarbor Plain, is the Great Western Renewable Hub, owned by, well, slightly different shareholding structure, but once again, Intercontinental Energy, the major shareholder. And they brought in a couple of Korean and Chinese people to sort of further the feasibility study. So it's interesting to see that people are still thinking about those projects at such scale, still thinking that hydrogen will be a valid business probably in about 10 years from now, because that's going to be about the time it's going to take to actually develop these things if they go ahead. But that's interesting. And meanwhile, Twiggy Fortescue is hosting a whole bunch of people, including representatives from Renew Economy up in the Pilbara this week, having a look at their electric trains and their batteries and their electric trucks and their solar farms. And so we'll be reporting on that one. That should be quite interesting. So I couldn't go, unfortunately, because I'm about to go on holidays, David. So I'm going to leave the show in your hands for the next 2 weeks.
That's a worry.
Be nice to the listeners. we've got one in the bag for next week. A view from Ireland and behind the meter, particularly for industrial and commercial consumers. An interesting perspective of what's happening in Australia and around the world. And then you'll be pulling a rabbit out of the hat, so to speak, in the following week. So
The world's my oyster.
indeed it is.
Here we go.
Okay, so look, thank you very much, David. Thanks to Sam Reynolds for Octopus Australia. Unfortunately, the video thing didn't quite work, but we've got the audio all right, so that's fine. Says something possibly about the quality of the NBN, and if for some businesses. Thanks, of course, to our sponsor, Pylon and
Evergen.
Evergen. Sorry, I just hiccuped right at an important moment. We'll be back with another episode of Energy Insiders this time next week, but it'll just be David. It won't be me. I'll be back in a few weeks' time. Thanks very much for listening, and bye for now.
Energy Insiders was brought to you by Evergen, the market-leading renewable energy software business that optimises residential and commercial solar and battery systems. Evergen enables large numbers of systems to operate as a single fleet, so network operators can use them as a virtual power plant, generating significant value for consumers, network operators, and the energy system as a whole. Evergen software is powering the energy system of the future. Energy Insiders was also brought to you by Pylon. Pylon provides easy-to-use solar design software for installers and retailers with pay-as-you-go pricing, no monthly cost and no lock-in contracts. Join Australia's top solar companies who trust Pylon to design high-resolution, CEC-ready solar proposals.